We will delve into the fascinating world of stock market investing, focusing on personal strategies that can help you navigate this complex landscape. Our aim is to equip you with the knowledge and tools necessary to make informed investment decisions. By the end of this video, you can expect to learn about various stock market strategies, including fundamental and technical analysis, as well as the importance of diversification and risk management. Understanding these strategies is crucial, as they can significantly impact your investment outcomes and overall financial health. The stock market offers immense potential for financial growth, but it requires a solid grasp of the principles that govern it. Whether you are a novice looking to dip your toes into investing, or an experienced trader seeking to refine your approach, this video will provide valuable insights tailored to your needs. We will explore how different strategies can align with your personal financial goals, helping you to build a robust investment portfolio. Additionally, we will discuss common pitfalls to avoid and the importance of maintaining a disciplined approach to investing. Engaging with the stock market can be both exciting and rewarding, but it is essential to approach it with a well-thought-out plan. By understanding the various strategies available, you can position yourself for success and take advantage of the opportunities that the stock market presents. So join us as we embark on this journey to unlock the secrets of stock market investing and discover how you can achieve your financial aspirations. Stocks represent shares of ownership in a company, allowing investors to claim a portion of the company's assets and earnings. When you purchase stocks, you essentially buy a small piece of that company, which can entitle you to a share of its profits, typically distributed as dividends and voting rights in certain corporate decisions. The primary goal of investing in stocks is to achieve financial gain, as the value of stocks can appreciate over time, leading to capital gains when sold at a higher price than the purchase price. This potential for growth is what attracts many investors to the stock market, as it offers opportunities to build wealth over the long term. However, for those new to investing, the stock market can be overwhelming and confusing. Many individuals struggle to understand the various types of stocks, such as common and preferred shares, and how market dynamics influence stock prices. Additionally, the terminology and concepts associated with stock trading can be daunting, leading to uncertainty about where to begin. It's common for beginners to feel lost amidst the myriad of investment options and strategies available. This confusion can deter potential investors from taking the first step toward building their portfolios. By demystifying the concept of stocks and clarifying their role in company ownership, we hope to empower you with the knowledge needed to navigate the stock market confidently. Understanding the fundamentals of stocks is essential for anyone looking to invest and capitalize on the financial opportunities that come with owning a piece of a company. In the realm of stock market investing, two primary methods for predicting market trends are technical analysis and fundamental analysis. Technical analysis involves examining historical price movements and trading volumes to identify patterns and trends that can inform future price behavior. This strategy is particularly favored by day traders who seek to capitalize on short-term price fluctuations and make quick profits. In contrast, fundamental analysis focuses on evaluating a company's financial health, including its earnings, revenue, and overall market position. Long-term investors typically employ this method, as they aim to understand the intrinsic value of a stock and make informed decisions based on a company's potential for growth over time. While both strategies have their merits, it's essential to recognize the differing focuses of day traders and long-term investors. Day traders prioritize immediate market movements, often making multiple trades within a single day, while long-term investors adopt a more patient approach, holding onto stocks for extended periods to ride out market volatility. Regardless of the strategy you choose, it's crucial to keep your investment approach simple. Overcomplicating your strategy can lead to confusion and poor decision-making, especially for those new to investing. By focusing on the fundamentals of each method and understanding your investment goals, you can develop a clear and effective strategy that aligns with your financial aspirations. Simplifying your approach not only enhances your ability to make sound investment choices, but also helps you stay disciplined in the face of market fluctuations, ultimately leading to more successful outcomes in your investment journey. Index funds are investment vehicles designed to replicate the performance of a specific market index, such as the S&P 500, which comprises 500 of the largest publicly traded companies in the United States. One of the primary advantages of index funds is their inherent diversification. By investing in an index fund, you gain exposure to a broad range of companies across various sectors, which helps mitigate the risks associated with individual stock investments. This diversification can lead to more stable returns over time, as the performance of one company is less likely to significantly impact the overall fund. Additionally, index funds typically have lower management fees compared to actively managed funds, making them a cost-effective option for investors. The S&P 500, for instance, has historically provided solid returns, making it a popular choice for those looking to invest in a diversified portfolio without the need for extensive research on individual stocks. While index funds offer numerous benefits, there is still value in individual stock picking for those willing to conduct thorough research and analysis. Picking individual stocks can lead to higher returns if you identify undervalued companies or emerging market trends. However, this approach requires a deeper understanding of the market and a willingness to accept higher risks. Striking a balance between index fund investing and individual stock selection can be an effective strategy. By allocating a portion of your portfolio to index funds for stability and diversification, while also investing in select individual stocks, you can potentially enhance your overall returns while managing risk effectively. Financial metrics play a crucial role in stock evaluation, serving as the backbone of quantitative analysis, which involves the use of numerical data to inform investment decisions. By analyzing these metrics, investors can gain insights into a company's financial health and performance, enabling them to make informed choices about buying or selling stocks. Key financial documents, such as balance sheets and income statements, provide essential information for this analysis. The balance sheet offers a snapshot of a company's assets, liabilities, and equity at a specific point in time, while the income statement details revenue, expenses, and profits over a given period. Together, these documents help investors assess a company's operational efficiency and financial stability. For instance, calculating the price-to-earnings (PE) ratio, which divides a company's current share price by its earnings per share, allows investors to gauge whether a stock is overvalued or undervalued relative to its earnings. Another important metric is the current ratio, calculated by dividing current assets by current liabilities, which indicates a company's ability to meet short-term obligations. Additionally, the return on equity (ROE) ratio, derived from net income divided by shareholder equity, measures how effectively a company generates profits from its equity investments. By utilizing these financial metrics and calculations, investors can better understand a company's performance and make more strategic investment decisions. Ultimately, a solid grasp of financial metrics is essential for anyone looking to navigate the stock market successfully, as it empowers investors to evaluate potential risks and rewards associated with their investments. Brand recognition plays a pivotal role in investing, as it significantly impacts consumer trust and loyalty. When a brand is well known and respected, consumers are more likely to choose its products or services over competitors, which can lead to increased sales and market share. This consumer trust translates into financial stability and growth for the company, making it an attractive option for investors. A strong brand can also command premium pricing, enhancing profit margins and contributing to overall stock performance. In addition to brand recognition, effective company leadership is crucial in driving stock performance. Leaders set the strategic direction of a company, influencing its culture, operational efficiency, and ability to innovate. Strong leadership can inspire confidence among investors, as it often correlates with sound decision-making and long-term vision. Companies with visionary leaders who can adapt to changing market conditions are more likely to thrive, making them appealing investments. Furthermore, emerging industries present significant potential for growth, often driven by technological advancements and shifting consumer preferences. Sectors such as renewable energy, biotechnology, and artificial intelligence are gaining traction, attracting investors eager to capitalize on the next wave of innovation. Companies that establish strong brand recognition within these emerging markets can position themselves as leaders, further enhancing their appeal to investors. As these industries evolve, the combination of brand recognition and effective leadership will be critical in determining which companies succeed and which fall behind. For investors, understanding the significance of these factors can lead to more informed decisions and potentially higher returns in a rapidly changing economic landscape. News and social media have a profound influence on stock prices, often driving market behavior in unpredictable ways. Rumors and breaking news can create immediate reactions among investors, leading to rapid fluctuations in stock prices. Positive news, such as strong earnings reports or favorable regulatory changes, can boost investor confidence and drive prices up. Conversely, negative news, like scandals or poor financial performance, can lead to panic selling and significant declines. The GameStop situation serves as a compelling case study illustrating these dynamics. In early 2021, a group of retail investors on social media platforms like Reddit banded together to buy shares of GameStop, a struggling video game retailer. This coordinated effort led to a massive surge in the stock price, driven by both enthusiasm and the desire to challenge institutional investors who had shorted the stock. The situation highlighted how social media can amplify rumors and create a frenzy, resulting in extreme volatility. While the GameStop phenomenon showcased the power of collective action among retail investors, it also underscored the risks associated with hype-driven investments. Many investors who jumped on the bandwagon without fully understanding the underlying fundamentals faced significant losses when the stock price eventually corrected. This scenario emphasizes the importance of exercising caution and conducting thorough research before making investment decisions based on social media trends or market hype. Investors should be aware that while news and social media can provide valuable insights, they can also lead to irrational behavior and volatility. A disciplined approach to investing, grounded in sound analysis, is essential for navigating the complexities of the stock market. Recognizing shifts in industries is crucial for making informed investment decisions, as the evolution of sectors can significantly impact market dynamics and investment opportunities. Industries are constantly changing due to technological advancements, consumer preferences, and regulatory developments. Investors who stay attuned to these shifts can identify emerging trends and capitalize on them before they become mainstream. For instance, the renewable energy sector is undergoing a significant transformation as the world increasingly prioritizes sustainability and reducing carbon emissions. Companies involved in solar, wind, and electric vehicle technologies are experiencing rapid growth, presenting lucrative investment opportunities for those who recognize the shift toward greener alternatives. Similarly, the healthcare industry is evolving with advancements in telemedicine and biotechnology, driven by the need for more accessible and efficient healthcare solutions. The COVID-19 pandemic accelerated these changes, highlighting the importance of innovation in healthcare delivery. Another sector experiencing notable shifts is the technology industry, particularly with the rise of artificial intelligence and automation, which are reshaping how businesses operate and interact with consumers. As these technologies become more integrated into everyday life, companies that adapt and innovate will likely thrive. Encouraging viewers to consider future trends when investing is essential, as it allows them to align their portfolios with sectors poised for growth. By analyzing industry shifts and understanding the factors driving change, investors can make strategic decisions that enhance their potential for returns. Staying informed about evolving industries not only helps in identifying promising investment opportunities, but also aids in managing risks associated with outdated or declining sectors. Ultimately, recognizing these shifts is key to navigating the ever-changing landscape of the investment world. Dollar cost averaging, DCA, is an investment strategy that involves consistently investing a fixed amount of money at regular intervals, regardless of market conditions. This approach helps mitigate investment risks by reducing the impact of market volatility on the overall investment. Instead of trying to time the market, which can be challenging and often leads to poor decision-making, dollar cost averaging allows investors to purchase more shares when prices are low and fewer shares when prices are high. Over time, this strategy can lead to a lower average cost per share, ultimately enhancing potential returns. For example, imagine an investor who decides to invest $100 in a particular stock every month. In the first month, the stock price is $10, so the investor buys 10 shares. In the second month, the price drops to $5, allowing the investor to purchase 20 shares. In the third month, The price rises to $20, and the investor buys 5 shares. By the end of 3 months, the investor has spent $300 and acquired 35 shares, resulting in an average cost of approximately $8.57 per share, despite the stock's price fluctuations. Encouraging viewers to adopt this strategy can lead to long-term success in their investment journeys. Dollar cost averaging not only helps reduce the emotional stress associated with market timing, but also fosters a disciplined approach to investing. By committing to regular investments, individuals can build wealth over time, taking advantage of market fluctuations while minimizing risks. This strategy is particularly beneficial for those looking to invest for the long term, as it promotes consistent growth and helps investors stay focused on their financial goals. In this video, we've explored several key strategies for stock market investing that can help you navigate this complex landscape with confidence. We discussed the significance of understanding both technical and fundamental analysis, highlighting how these methods can inform your investment decisions. We also examined the benefits of index funds compared to individual stock investments, emphasizing the importance of diversification and cost-effectiveness. Additionally, we delved into the role of financial metrics in evaluating stocks, showcasing how balance sheets and income statements can provide valuable insights into a company's health. Furthermore, we highlighted the impact of brand recognition and leadership on stock performance, as well as the influence of news and social media on market behavior. Recognizing shifts in industries is crucial for identifying emerging trends and investment opportunities, while dollar cost averaging serves as a practical strategy for mitigating risks and promoting long-term success. As you consider these strategies, remember that informed decision-making is vital in the world of investing. Staying educated and aware of market dynamics can significantly enhance your potential for success. We encourage you to engage with us by subscribing to our channel, liking this video, and sharing it with friends or family who may also benefit from these insights. Your support helps us continue to provide valuable content and resources for investors at all levels. Thank you for joining us, and we look forward to sharing more tips and strategies to help you achieve your financial goals in future videos.